Hello, this is Surya Sahan. Welcome to the Insurtech Story Podcast, the platform to spread knowledge on insurance innovation, digital disruptions, and entrepreneurship. Our website, insurtechstory.com, and we are available on Spotify, Apple, Google, Audible, and Amazon Music. Today, we will discuss on the topic AIML in revolutionizing actuarial pricing in insurance. And for now, I'm delighted to welcome our guest, Suguna Jayaraj, who is the Director of Pricing at MIC Global. Suguna is a passionate data science leader with a 15 plus years of experience in insurance and banking industry. Before MIC, she led analytics at Swiss Re Reinsurance Solutions and ran the model development team of data scientists, data engineers, actuaries, geo special scientists, etc. in Bangalore. Prior to Swiss Re, she enabled marketing, product, and claims team to realize the potential of advanced analytics by increasing the top line and the bottom line at AIG. Besides, she worked in multiple roles involving underwriting, capital modeling, and wholesale banking in the BFSI space with HSBC and American Express. In addition, she has helped scale consulting startups and owned an e-commerce startup for a short stint. She was honored as 40 under 40 data scientist by Analytics India magazine in 2021. She has co-authored 2 research papers in the insurance industry, ML-based geoscore to improve auto insurance pricing and crime score for liability pricing. So Suguna, a warm welcome to the show.
Thank you, Surya. Thank you for having me here.
So Suguna, to quickly jump on to the discussion agenda for the day, I'm really curious to understand, where do you see the key reasons behind the shift from traditional actuarial pricing methods to AI and ML-based approaches in the insurance industry? And being in the data science field for more than 15 years, if you could just shed some light for our listeners.
Yes, sure, Surya. So I'll just start with a little briefing on to what exactly actuarial pricing is, right? So actuarial pricing has pretty much been around for as long as there have been insurance companies. So now it's a multidisciplinary study and an intersection of mathematics and statistics, which was traditionally put together to price a risk. So to give a little history, right? So the Gen Zero pricing, as we call it, used to be done with the help of mortality tables, one-way tables, experience studies, and simulation of large losses for low-frequency, high-severity events. And now, over a period of time, with the maturity of industry, the product evolution, the computational capabilities, and the availability of historical loss data, the Gen 1 models came. So, which are the GLMs and GAMs, the generalized linear models, the generalized additive models. So, they started getting standardized in the last 2-3 decades and they started being used commonly for pricing. So, they follow a frequency severity approach where, there are 2 separate frequency and severity models built together and they're combined, or a single loss cost or a pure premium model is built. So these are very multiplicative models and parametric in nature. So they're very intuitive to understand and very effective to capture the rates. So there are final rating tables which the actuaries use, and then finally adjustments are done on top of it to give a final pricing structure. So now I would say that the shift is happening in the last, few years. So from a technical point of view, if you have to address, right? So 3 key reasons. First one, I'll address it from a technical point of view. So as the number of, now with the growing data sources, right? So as the number of predictive variables increase, so handling non-linearities become challenging with these traditional models. Also, these models assume a Poisson distribution for frequency model and a gamma distribution for a severity model. So these distributions become very complex and sometimes they don't fit in. So which is why the generation 2 models came in, which are the machine learning integrated into these traditional models, because the feature engineering becomes simpler. So the model development and the selection of the attributes do not require manual effort. So this is exactly where a combination of ML and these GLM becomes a best solution and can help insurers in achieving a competitive edges. So the granularity, of course, improves in helping choosing a better customers and preventing anti-selection as well. So now the second point of view is from an alternate insurance product structure. So even the product structure for insurance is evolving. So the products, current policies that have been existing in the market are very cumbersome. Where we take, let's say motor or liability lines. So to increase the penetration, so a lot of simplification of these products and the covers are happening in this space. And micro insurance, for example, is gaining more popularity. So it stands at a market size of about 75 billion globally as of 2023. So most of these micro products are embedded, say a glass breakage cover embedded into a parking slip, theft cover embedded into a surveyor camera, etc. So risk is now structured into bite-sized covers while technology and the platform allows to collect data from these systems to price them more systematically. Another example I would give here is from the mobility space. So where the exposure is getting redefined. So instead of, say, for example, selling a fixed 1 year policy, so we are looking at insuring one trip. I think we would have seen the ride sharing apps like Ola in India allows customers to insure their single trip for theft of articles which are left in the car or a personal accident. And they are also bundling it with travel delay policies when the customer is traveling to the airport. So these kind of custom products are coming in. And in US now, with the gaining popularity of telematics, the prices are not just the exposure is changing, but the prices can be tweaked based on how you drive, where you drive, whether it's an accident prone zone, and come up with a usage based insurance, which is a per mile pricing. So the exposure and how you price it changes very significantly. So an actuarial pricing in this case, right, so would typically involve looking at historical losses. So for example, in US, the largest body which collects the market data is ISO Verisk. And but unfortunately, they've been writing, most of the people in the industry have been writing traditional auto liability. So the losses that we get from them, those studies and everything becomes obsolete, and the pricing has to happen more real time. So this is exactly where machine learning, data science, and technology comes into play, and it pretty much becomes a data play, and the usage of auto ML helps in integrating the pricing or iterating it as you go.
So,
And coming to the,
yeah,
yeah,
sorry, go ahead.
no, go ahead.
So talking about, how AI ML can really bring the shift in traditional, actuarial side of it. As we understand AI ML, of course, looking at the automation side of it, how it can help insurance task, data processing, and preliminary analysis, and those are certain elements that it has a greatest impact. But
Yeah.
however, if you look at the complex decision making or strategic planning and other consideration, including what do you say on the governance side and so on and so forth, do you think AI can really be a replacement for actuaries in the future, or it will just be a component to just be leveraged for better decision making?
So I think that's a very interesting question because we are addressing two things here. One is the regulation and the role of actuaries, right? So this is always, a question on about how effectively actuaries can use, how effectively we can adopt to ML. So having said that, it is not going to be 100% or a replacement, right? So it would always be, especially when we're talking about pricing, right? So we would require, rate filings will be done. So there would be a regulatory approval of the variables which are being used. So one of the ways, which is why I was mentioning about a hybrid approach. So where I can give an example, right? So the motor policies, for example, have a location score. So now typically, the location would be done at a, at a very high level, right? So maybe at a district or whatever address is being captured may not be very accurate. And tomorrow we want to move to the territorial rating to a zip code or a location level. So that's exactly where uh, we could build a machine learning based score which would use all the external attributes capturing the risk of that location and then feed it into the traditional GLM models. So we will have a score which is agnostic to the distribution, And then again, because it will be offset and passed to a traditional GLM model, we will still have the coefficients. So then in that case, a territorial score just has an improvement in granularity, but still we will be able to get a regulatory approval on that. So this is one of the ways, to do it
Mm.
together. And how do you augment that?
No, absolutely well said. Talking about risk, uh, can you help us understand some of the top risk in the insurance industry today and how new data sources like sensors, telematics, IoT, social media even are being or can be leveraged by AIML models to better evaluate such risk. And I'm sure it's going to have an impact in the premium pricing and how the modeling is done.
Yeah, so I think probably I think when we're talking about the evolution of new data sources, right? So I would pick the digitization of industries that is happening, right? For example, manufacturing firms have started using IoT devices to their machines, which can track the equipment breakdown, or even dairy farms have started to have sensors which can track the whole milk supply chain and the cow's health. So now these data sources can be used very well to price the risk, design a cover, and sell it right. Make that technology as a distribution channel for pricing these products and selling these products. So not just that. So these are newer covers based on that. Plus, a lot of AI-based predictive maintenance alerts are set at these points. So that's one of the way, how with digitization we've been seeing a change in pricing.
Yeah, absolutely. So any experience that you have come across that you can highlight, in case if any?
Yeah, so maybe I can give another example, right? So about if we talk about, maybe about the emerging risk space, right? So now that we've spoken about new data sources and how the product is changing, industry is changing. So if you look at, the top risk according to World Economic Forum Global Risk Report, right? So out of, where they categorize risk into economic, environmental, geopolitical, social, and technological, 5 out of 10 within each actually fall into climate change related topics. So as a result of global warming, so pretty much the return period of some of these major catastrophic events, which used to be 1 in 500, has become now 1 on 100. So, to give some statistics around that, the economic losses arising out of these extreme weather events last year was close to 380 billion. And now only 31% of these losses are covered. So another staggering statistics from India is that last year, if you define extreme weather event, which is a deviation from what it should be, 318 out of 365 days was something that India experienced in at least one state. So now this is where insurance industry has a crucial role to play. So, for example, traditionally the CAT models. So now that we know we're talking about the catastrophe. So traditionally these models would cover majorly, or the major focus would be primary perils like tropical cyclones, earthquakes. But now these losses are coming from the secondary perils like wildfire, flash floods. So I think inland floods is something that caused major losses in India. So now with the advanced availability of multispectral satellite imagery, open street map data, and building exposure. So we are in a position to build models to price based on those microclimatic conditions. So this is not just insurance industry now. So large tech companies have started contributing to this now. For example, Google released its GraphCast model, which can provide weather forecast up to an accuracy of 90% for a 6 hour forecast. So it uses a combination of physics based method and reinforcement learning, and leverages all the atmospheric parameters to predict at a fine grid level. So now thanks to the open source culture as well, that these are available for insurance industry, and one of the agri based startup in India has adopted to these methodologies, and crop insurance is now priced differently for 10 different varieties based on the soil and the local weather conditions. So can you beat that?
Absolutely. I mean, when you talk about crop insurance, agriculture, I think that's kind of a livelihood for every economy, right? And when you
Yeah.
see, and to be very honest, especially in the Southeast Asian countries like India and others, insurance did not make a inroad in that sector as much as it should be that with respect to the penetration. And I think when technologies like AIML comes in and how insurance sector is really taking that
Yeah.
initiative to get in, I think it's going to be a game changer the way things are done in agriculture, especially
Yes,
in
yes.
all
So I
these
can
disadvantaged.
actually, yeah, so I can give from a crop insurance perspective, right? So now, especially, these extreme weather events, now we are talking about now, large covers when we say cat. So here again, parametric policies are on rise where,
Yes.
it can be very simple covers, specific to maybe, excess rainfall or, excess heat because, or, which can cause damage to these crops or, um, when we're talking about the growing renewable sectors, right? So in the renewable sectors, there are cloud cover based indexes which are created to price for the power fluctuations coming from the solar panels. So these are multiple use cases in which creating a parametric insurance becomes very simple by leveraging the satellite data and looking at the historical data from these IoT devices and tweaking them.
Right, right. Yeah, absolutely. Just moving on to my next question to you, Siguna, is what are some qualitative or rather quantifiable advantages of using AI and ML in actual pricing? And can you provide some good case studies or real examples where these technologies have really led significant improvements?
Yeah, so like here, I would say from the market as an industry, right? So overall, it's close to 80 billion in dollars of investment that's happening for AI in insurance across the value chain, and underwriting is a topmost use case. So in that, the very first thing that now that we're focusing on pricing, right? So I would leave claims and other use cases out. So here it's about improving granularity. So like the previous example I was giving, so the rating, which territorial rating, which probably happens at a district, say, state or a city level, from that it moves to a zip code. So naturally, we're talking about a flood risk of, if you know the risk of that particular point, right? So from the risk of maybe 500 by 500 kilometer grid, we are able to come to a precision of 1 kilometer by 1 kilometer grid. So that's exactly where we are able to price it accurately. The anti-selection of a portfolio roughly improves by 10 to 15%. The loss ratio improvement would be probably about 4 to 5%. So you can imagine the scale it translates to the size of the business. So that's how impactful it would be. And B, if we move to, from an efficiency standpoint, so apart from, the risk selection, so even the building model training time, so, the adoption and moving to cloud and utilizing the features from auto ML. So we are able to commoditize and, you know, having the implementation or, the operational time of cleaning the data, getting into, deploying the models, it's become very easy. So it brings in a lot of efficiency into the system, and the turnaround time, especially, it becomes critical, crucial when you're entering a new market, when you're designing a new cover or designing a new product. So in that case, bringing all those third party data into the system and being able to run models and create that. So then, the actuaries can actually focus more on
Yeah.
the risk and the work than, in things around that.
Yeah, yeah, absolutely. I think as a actual involvement from the human perspective, the the right focus on the decision making of these functions and modeling is more important than how you mentioned. If the other task can really be automated through AIML, so it makes a lot of sense on how productivity and at the same time the real outcome can be enhanced for better pricing.
Yeah.
Absolutely. Well, Sugina, fantastic discussion, really enriching thoughts on modeling, AI, and of course, a lot of numbers there. Thank you very much for sharing your thoughts. A true delight to have you as our guest. And of course, we'll see you again very soon. And lastly, to wrap this up, you are listening to the Insurance Story podcast, and see you at our next episode. Till then, take care and stay safe. Goodbye for now.
Thank you, Surya.